Welcome back in, everybody. So in this video, it's going to probably be a very long video. I don't know how many stocks we're going to do. I'm just going to go into it. Hopefully you guys enjoy. And the only thing I ask is just consider subscribing and smash that thumbs up. We are knocking on the door of 5,000 subscribers, and I can't thank you all enough for the kind words, the love and support you've shown this channel. I can't thank you all enough. So with that being said, I figured this would be a special video. I'm going to try to timestamp it, and we're going to get into a lot of different names. We're just going to go over valuations and update our analysis on a lot of these different companies. And we're still going to take the process that we always take. We're going to do our analysis. We're going to look at the charts. We're going to look at the earnings. We're going to look at the return on investment. And then we're going to compare that to what the experts say valuation should be on these companies and where they're currently trading as of today. As always, guys, really appreciate your time, and let's get into today's video. Stock number one I want to break into is going to be SBUX, ticker symbol SBUX. I'm sure you're all familiar with the coffee giant. This company pays over a 2% dividend and is currently trading at a forward PE sitting at 25 times earnings. Now, historically, we've seen this company pretty much grow double digits as of late, starting to go single-digit revenue growth. So we're seeing that growth rate slow down, which is definitely going to cause concern as far as valuation goes. When we look at analyst forecasts, we have everything as low as $76 and as high as $120. Currently, the stock is trading at $96. Now, I personally believe a good entry point if you're looking for outsized rate of return, you have to get in the stock in the high 60s. So I have an ideal entry price basically below $63. Now that's using a 9% buffer rate. And then when we factor in that 2.5% dividend yield, we're looking at over 11% compounded rate of return annually. That's ideally what we're trying to look to get when we look at total returns. But really quick, I want to update where my revenue is versus where expectations are. So as you guys can see, this is an older model that I did back in 2023. So I was expecting 2024 earnings to come in around 37 billion, 2025 to come around 38 billion, just shy of actually 39 billion. So if we look at analyst expectations in 2025, they're projected to do 39 billion, and in 2026, 42, call it $43 billion. We go back to our chart, and we can see here that we are underestimating revenue growth on the company. So we're going to bump up our revenue growth estimations here. And by doing so, we get an ideal stock price around $65 a share, still using that rate of return. So as you guys can see, not only is their coffee expensive, but the stock is actually fairly expensive. Looking at the 3-year chart, it had a high of $126 and a low of $50 during the pandemic, and has recently got as low as $72 a share. And so we had a double bottom right around that $72 a share. You had some time to accumulate. And actually, I think that's at a reasonable area to build into this position. So we can see when we get close to that $75 mark, that might be a good area to average in on a technical basis. And then when we look at valuation, it's not too far off from my $65 price target. Now, if we look at $4 worth of earnings, and this company historically trades around 20 times earnings, we don't really need to do anything crazy here, but basically we could be looking at an $80 stock. So multiple reasons why I think that this might be a little overpriced. When we look at ratings and reports, Schwab has it rated as a D. You want to see this in the upper percentile, basically 50% and above. There might be some value here. So even Schwab is saying that this might be a little expensive. We go to Morningstar, they give it a 3-star rating, and they believe that this has a wide economic moat. But even from Morningstar analysis here, we can see that it was a $77 stock when they did their analysis, and they think fair value is probably closer to $95 with this large moat. Next up is an interesting one. It's Keurig Dr. Pepper. This is one that's always piqued my interest, but unfortunately, once again, valuation has always seemed to be a little bit rich on this one. But with the forward PE sitting at 18 times, this one's getting a little interesting at these levels. We can see nice steady upline trajectory here on the 1-year chart. And on the 5-year chart, we're starting to reapproach recent highs. One thing we'd like to see them do better is get a higher rate on and return on invested capital. So that's definitely one area I'd like to see them do a little bit better at. Analyst forecasts have a low of $34 and a high of $43. Currently, the stock's sitting at $37. Not a lot of upside, not a lot of safety built, in my opinion, when we look at where analyst expectation is. When we look at where analyst expectation is versus where the stock is currently trading. On a forward basis, they're looking to do right around $2.09 of earnings. When we look at valuations, definitely a little bit of a premium here, but they are growing around 4% while industry standards growing around 3%. So a little bit more opportunity for growth possibly, but definitely seems like it's pretty much at full price at this point in time. Cash and cash equivalents are sitting at 267 million. Total debt sitting at 14.8 billion. Personally, I believe the balance sheet's a little lopsided on this one. A lot of debt on Keurig Dr. Pepper. So for this one, I do love their brands and I love what they represent, but unfortunately, this one's getting a little too expensive in my opinion when we look at it. It's really trading with your Pepsis and your Coca-Colas, and I just don't think it has the earnings power and the balance sheet that those quality companies have. So in that case, I do still believe that it needs to be trading for a discount when we compare it to its peers, especially when we compare it to a Pepsi or a Coke. And when I look at the balance sheet, it's nothing super impressive. So for those reasons, I'm going to steadfast and say that this is between a $20 to $22 stock. And just like my wife, Schwab is telling me that I'm wrong here. Nothing new. They give it actually a 32 percentile, giving it about a C grade for market performance going forward and for valuation. And then Morningstar actually is on the same page as me. They believe that the moat is fairly narrow and they give it a 2-star rating. Now, they did this analysis when the stock was trading around 36 bucks, and they think fair value sitting around $32 a share. Because our end result, we believe that the fair market value for the company in 2032 is going to be right around $44.50. Next up is another company that's piqued my interest multiple times. That's going to be Airbnb. This was a hot ticketed IPO that's kind of flopped here. We've seen it get as low as $85 a share during the pandemic. Now it's starting to creep back up. Over the last couple of years, we're seeing revenue growth and earnings follow here. Forecasters have a $90 a low and a $195 as a high. Big time disparities here. Obviously, it could go in either or direction when we look at what analysts expect. Currently, the PE ratio is sitting around 17 times, with the forward P sitting at 30 times. They're projected to grow right around 9 to 10% going forward and doing right around $12.3 billion in revenue in 2025 and $13.7 billion in 2026. This one was probably one of the first analysis that I've ever done, and you guys can see here that this was pretty much done in 2021. And I got an ideal stock price sitting closer to 80 bucks a share, 75 to $80 a share, call it. And it did get pretty darn close to those levels during the pandemic, which means that you might have had an opportunity. This is a company that has over 10 billion in cash and cash equivalents, total debt sitting at 2.3 billion, so extremely clean balance sheet. And when we look at return on invested capital getting over a 10% rate of return, that's also nice to see. So that is a bonus as well. So some things I'm actually liking about Airbnb, even though the price is a little bit rich, it looks like. Schwab gives it a 70 percentile, basically a C, and Morningstar gives it a 3-star rating with a narrow moat. Now, Morningstar did the analysis when the stock was trading around $115 a share. We can see here that they believe fair market is closer to 130. And so this one's actually a pretty big disparity from me personally. Now, if I bump my rate of return down a percentage, I actually get between 83 to almost a $90 stock price, which is probably more realistic to where the stock could trade, but I always build extra safety in my analysis. So I'm going to say between $75 to $80 is still in the wheelhouse here for Airbnb. Now, I know right now it seems like it might never hit these levels as the stock's trading at $126 a share. We saw it get as low as around $85 a share during the pandemic. 52-week low in the stock is sitting at 110. So maybe it never hits my ideal stock price, but this is where I still feel like you have to be disciplined and wait for your opportunities. One stock that's had a low valuation and just seems to never get out of its own way is definitely Ford Motors. Trading at nearly 11 times earnings and a forward P sitting at 5. We're looking at over a 5.5% dividend yield. So if we factor in that dividend yield to total returns, we really don't need a tremendous amount of stock appreciation. We look at the 5-year chart. Pandemic low was sitting around $3 and change, shot up to $25 a share, and now it's trading around 10, 11 bucks a share. Analysts have a low of $9 and a high of 18, and revenue growth is projected to be fairly flat over the next 3 years. And so I actually have an ideal stock price sitting right around $9 a share, $9.88. So anything under 10 definitely becomes pretty interesting in my opinion when we look at Ford Motors. Now, if we're thinking about the economic cycle here, we could see Ford Motors really get back down to $7, $8 a share. Those high ticketed items could get hammered if we do go into some sort of recession or have a slowdown. When we look at Schwab gives it a B rating, and I'm actually kind of on board with Schwab as well, giving it a 12 percentile, meaning that it's probably undervalued and there was some opportunity here. Morningstar gives it a 5-star rating. That's kind of rare to see. It says the economic moat is non-existent, so a very competitive market, and that's why margins are getting squeezed for a lot of these car companies. But when we look at valuation, it's pretty compelling. They believe the stock's probably worth closer to $19 a share, and they did that analysis when the stock was trading around $10.75. So I'm going to stick to my price target of $9.50 for Ford. Next one up is the Walt Disney Company, ticker symbol DIS. You guys can see here after the pandemic, it skyrocketed, getting into the streaming business, pushing over $200 stock, and now it's trading around $94 a share, and we've seen it get as low as $78 a share. Now, the thing I want to point out here is this is actually a company still growing its top line revenue, and it's starting to work on efficiencies. Streaming is starting to become profitable, and I do think if you were to separate these assets, they would actually be worth a lot more separated than they are as a whole, and so this is where we could unlock some value here. One of the areas we'd like to see them do much better in is definitely going to be return on invested capital, sitting at 4.6%. We'd like to see that get to double digits. Analysts have price targets as low as $91 and as high as $141, kind of sitting in the middle ballpark here around $95 a share. For 2025, they're projected to do $95.8 billion, and in 2026 break above $100 billion in top line revenue, growing right around 4%. This is a company that did reinstate a dividend, sitting just under 1%, so almost negligible at this point in time, but if they start growing that dividend, it's something we want to incorporate into our analysis. So for Disney Company, I have a multiple of EBITDA, putting it around $89 a share, and from a free cash flow standpoint, $74 a share. I personally think anything under $80 is very, very interesting in the Walt Disney Company. Schwab has this as a 71 percentile, so they're not seeing a tremendous amount of upside in this. Morningstar actually sees this as a 4-star rating with a wide moat, and I would tend to agree with that. There's not many other Disneys out there, and you can't really copy this. Now, they ran this analysis when Disney was trading around $89 a share, and they believe fair market value is probably sitting closer to $115. This is a company I actually find pretty interesting because people either think it's really undervalued or they think it's really expensive. I'm kind of in the middle ballpark here. I think anything under $80 a share puts it in a real reasonable area when you look at all the assets that this company owns. And what's really under this umbrella is pretty powerful. And the fact that they do have a pretty massive moat here. Love the fact that streaming is now profitable. And if they can get a higher return on invested capital, I do believe that this stock can actually get above $120 a share pretty quick. Once again, similar to Ford, it depends on where you think we are for the economic cycle. If you think we're late cycle, people are probably not going to be paying those high ticketed items, which could actually lend an opportunity to buy Disney on a downturn if we do go into a recession. As always, guys, I'm going to end it here. Really appreciate your time. Hopefully you enjoyed, and we will see you in the next one.